Good morning and welcome to the Killik & Co market update. We've had quite a choppy week on markets this week, with US markets falling more than 3% on Wednesday, largely due to an inversion of the yield curve. Now, what does this mean? Well, the yield curve really shows the relationship between the maturity of debt or bonds and the yield on that debt. So let's take government debt as an example. If you're going to lend the government money, and you've got the option of lending money for either 2 years or 10 years, you would expect a better annual return for the 10-year option because you are locking your money away for longer. And the yield curve is really a chart that shows that relationship. So on the x-axis, you have maturity, and on the y-axis, you would have yield. And you would expect that curve to be upward sloping because you would expect to get that better return for locking your money away for longer. So the normal yield curve is upward sloping. However, sometimes you do get an inversion of the yield curve, and that means that investors are getting a worse return for that longer dated debt. Now, some economists do believe that this is a predictor of recession. They believe that if the yield curve is inverted, it means that investors are willing to overpay for the longer dated debt because they are so worried about being in the equity market that they would rather just be in debt at any price. So when the yield curve in the US, and also the UK for that matter, inverted on Wednesday this week, we did see quite a significant downfall in global stock markets. However, a couple of things to bear in mind. When the yield curve has inverted in the past, there has always been quite a time lag between the time of inversion and the next peak of the stock market. So on some previous occasions, there has been a further 2 years of stock market gains after a yield curve inversion has taken place. But I think the main thing to bear in mind is that over the last 10 years, we've had huge amounts of quantitative easing taking place. Central banks have bought huge amounts of bonds, and that has caused some quite major distortions in the bond markets. So I think it's worth considering whether or not that traditional economic theory about the yield curve is still valid. And with all this talk about inverted yield curves and about low bond yields, we've been taking a look at the yields that is possible to obtain on equities. So let's have a look at the FTSE 100, which has always been quite a high yielding index. Now, over the last few years, the yield on the FTSE 100 has been rising. There are a couple of reasons for that. One is that some UK stocks have sold off because people are worried about Brexit, and that means that the yields on those stocks are higher as a percentage of those lower share prices. It's also true that a number of FTSE 100 constituents report their dividends in dollars, and because sterling is currently so weak, it means the dividends are higher when converted back into sterling. So if you have a look at this chart here, which shows the yield on the FTSE 100 over the last 10 years, you can see that yield has been rising quite significantly recently. And at the moment, the overall FTSE 100 index is yielding about 4.5%. And I think you've got to consider how attractive that looks in an environment where you can only get less than 0.5% return for a 10-year government bond. So I think it is worth considering the yields on global equities at the moment. And finally, this week, we've had some more negative data out of Germany, and it was announced that the German economy actually contracted in the second quarter of this year. It's been a tough couple of years for Germany. It previously seen as one of the strongest economies in Europe, and it was particularly strong in the industrial sector, particularly the car market, and we know that the car sector has been struggling recently. Also, Germany has always been very strong in the export market, and I think that's been hit quite hard by this trade war between the US and China. In fact, because the Chinese currency has weakened so much recently, it's become a lot more expensive for the Chinese to buy from Germany. And I think that's just one thing that has hit the German economy. We've also got Donald Trump talking about the possibility of imposing tariffs on the European economy. And I think that's just one more thing that's weighing on investors' minds. So quite difficult to invest in Germany and the wider European economy at the moment. Now, moving on to the week ahead, it's fairly quiet in terms of companies reporting next week, but we have got results out from Estée Lauder and also from Copper Miner and Antofagasta. That's it from us. Have a great weekend, and we'll see you next Friday.